Dominating the headlines today, President Trump's massive tax and spending bill, which has passed the House of Representatives, and the prediction is that it will add trillions of dollars to the US deficit. And that is weighing on bonds. Let's put up the 30-year bond yield, for example, that has topped that psychological 5% mark. Let's get more from Kurt Reiman, Head of Fixed Income Americas at UBS Financial Services. Kurt, thank you very much indeed for joining us. Quite the sell-off in the bond market. Is it because of the deficit? Because we have seen a rise in other long-term bond yields around the world as well.
Right, and the rise in bond yields in other countries you were discussing earlier, Japan, Germany, these do tend to be correlated. So let's keep that in mind. The long end of the yield curve does move directionally, but the U.S. is not the only place in the world that is seeing an increase in deficits. Part of the reason why we had a lackluster auction in Japan was due to concerns about their own domestic fiscal programs. And of course, we've seen in Europe an increased willingness to think about spending on areas like defense. So the U.S., I mean, I wouldn't put all of the weight of the rise in yields solely on what's happening with fiscal policy. There has been a bit of an improved cyclical environment over the past, say, couple of weeks since the tariff threats were taken down, a bit of a de-escalation. You've seen some repricing of the expectations for the Fed to cut interest rates. The short end of the inflation market, short end inflation expectations, those have moved sharply higher. So, there's a lot of things moving at the same time. I do think that the deficits can be part of that, but let's not also get carried away here. This has been a fairly gradual, kind of creeping move higher. That is something that I would say is when you're thinking about, the risks in bonds, that's a better environment than a sharp, steep sell-off like we saw in early April.
That's interesting. And sorry, touch on inflation. So there are fears that the developed world or the wealthy countries are at risk of inflation?
Well, we've seen inflation come down. The reported inflation has been moving in the right direction. It's still above the Fed's target, but it's been moving closer to 2. Now with tariffs at an effective rate of 15%, that's 6 times the level in 2024. That's more than likely going to feed through into product prices. The administration had been talking about strengthening dollar doing some of the heavy lifting, if you will, to kind of cushion the effect on U.S. consumers. The dollar, of course, has been moving in the other direction. When I was referring earlier to was expectations, which come from the University of Michigan Sentiment Survey, and those have risen quite sharply. So the 1 year ahead expectations for inflation, which we know isn't going to be priced into the back end of the curve, but it matters. It's sort of an indication that maybe inflation has been trending in the right direction. With tariffs, it'll start moving, in the wrong direction.
You think America's tariffs on its trading partners are likely to settle around 15%, but with a higher level for China?
That's correct. And I think one of the pieces that's missing in this analysis of the fiscal impact is the tariff revenue. We have about $3 trillion in imports. Now, of course, with higher tariffs, some of that will come down. I don't think it'll come down a lot. So if you're at a 15% effective tariff rate, then you're bringing in $450 billion a year in revenue. And at those levels, that you're talking about that's 1.5% of U.S. GDP. So this is not insignificant revenue from the standpoint of the fiscal projections. It is partly an offset, but as we think about tariffs, and you were mentioning the question about sort of differentials by geography, there are clearly 3 zones. There's North America, which is largely, I'd say, kind of a fortress with relatively low single-digit tariff rates. We have the rest of the world ex-China, which is kind of on average around 10%. And then China's at 40. Could come down some. There's still room for further negotiations. What I think is important about the whole tariff discussion and dynamic is that we've moved into a zone now where I think the range of outcomes is more narrow. We're not going back to the all-out reciprocal tariffs, maybe for a few countries, and there could be room for them to even come down from here further. It's not just biased higher. We're not going necessarily to worst outcomes. We could see both deals and, importantly, these court cases that are working their way through the U.S. court system. The plaintiffs, the judges have been siding, it seems, with the plaintiffs, and so there's room for an injunction, or for these universal tariffs, or the tariffs on fentanyl and immigration under the International Emergency Economic Powers Act to be declared illegal. So we have to be on the lookout for that. It's very important.
That's interesting. The so-called emergency tariff slapped on because of drug imports and allegedly loose borders could be struck down by the courts, in other words.
I wouldn't rule it out. These have never been tried before. The IEPA, the International Emergency Economic Powers Act, that is silent on tariffs. And recent Supreme Court rulings back last summer would suggest that the Supreme Court, if they end up receiving this, have sort of looked at administrations and said, you can't draw outside the lines. Do what's in the statute, not more. And this is not in the statute. So it's not that these would be declared illegal and then they would go away. It's just that they would shapeshift. They would move into other statutes that have been used historically, like Section 231, Section 301, or Section 232, which would mean more limited use and probably wouldn't be as applied, sort of evenly across all countries the way they are now.
Cart, we better go. Thank you very much indeed for joining us.
Good to be with you.
Reiman, Head of Fixed Income Americas at UBS Financial Services.